Okay, good morning, everyone, and thanks for joining me today for the option writing webinar that we have. And in this webinar, what we are going to learn is that, traditionally the way that we write options or how exactly people write options and what are the benefits of writing options and what are the generic mistakes that people do and using the tool that we have, the algorithm that we have of concept writing, how you can go and improve the option writing trades that you might already be doing. So for all those people who write options, my question to you is that let's say if you're writing option right now, then what will be the strikes that you'll choose? So given that Nifty, let's say currently whatever the level of Nifty is, for ease, if we say 16,500 roughly is where the Nifty is. So if the Nifty is at 16,500, then which strike on the upside will you write and which strike on the downside will you write? I understand it's a monologue, so I can't really interact and understand what the responses are, but generally people make a mistake of keeping it equidistant. So before I get to that entire topic of why people choose to do equidistant and what should be the right way of doing it, let me just give you a background of what option writing payoffs are. So quickly, let me just share my screen, and what we will do is we will just look at if anybody is writing option, and if the only edge in writing option is theta, which basically means that on a daily basis, you just come to the market and you just sell options. Okay, you're not adding any different forecasting or a different value to it. You just come to the market and you write options. What happens if we do that? So if you think of it logically, we can go and plot the option writers payoff, the historical payoff, or how much money option writers have made in past, and we can go and see it even now. How will we do that? We can achieve that by just plotting something called as IV minus FRV. So let me give you a background of what IV is and what FRV is. So IV is the expectation of how much will be the volatility which the market expects. Okay, so there are basically three terminologies. One is historical volatility, which we are not going to use today. Historical volatility means that what has happened in past, but implied volatility means that what is the market's expectation of what will happen in future. Okay, so that's a market expectation, but will the market do the exact same thing of the market, what the market expectation or the market participants expectation was? The answer is no. Because even though the IV today might be at a different level, but tomorrow the market movement can be completely different, right? So that what will actually happen in future is called as FRV, which is future realized volatility. So as an option writer, what you basically do is that you sell implied volatility, because you'll go and sell the options that are available in the market at whatever cost it is available. And basically, if you have to normalize what is the cost at which the option is available, then that cost is generally called as IV, right? You're selling IVs, and eventually what will happen is that those IVs are high, let's say, and the market does not move that much. So those IVs will keep converting into theta and it will keep decaying. So that's how basically option writing works. So let's come back to that concept again, that if you just come daily in the market, and if you just sell options, might be 300 points plus minus, might be ATM straddle, what basically you are doing is you are just selling implied volatility. And if that is a consistent static strategy that you're following, then you are just selling implied volatility. And whatever happens in the future, the actual volatility that happens in the future is something that you're buying, right? You're selling IV and you're buying FRV. So if we have to go and plot what has been the writer's payoff historically, right? So we can achieve that by, let's say, I'll just go in the tool and I'll open the IV thing. And what I'm interested in is looking at what will be the IV minus FRV. So there are a lot of line charts that we do see here. So what we'll do is we'll just remove the other data points which we don't need for now. And what we are talking about is the green line in this chart is the implied volatility, and the blue line in this chart is the actual future realized volatility. So whenever the green line was above the blue line, we can say that in those times the option writers made money. And if the blue line was above the green line, it basically means that the actual volatility of the underlying was much higher, and which basically means that you sold options cheaper and the underlying volatility was much higher. So option writers lost money. So if we do a very simple IV minus FRV, right? So to see what was the profitability, and let me just plot it slightly historically from, let's say, 2019, January 1st January 2019 till date. If we look at what has been the IV minus FRV, so you can see that this histogram is the option writers payoff. If I tell you to go and, so all the green bars that you see are basically the option writers profit, and all the red ones that you see are the option writers losses, right? So if you just go and, let's say, add in, obviously you cannot just exactly add it, but if you just go and add all the data points that we see here, all the greens, add all the greens and reduce all the red out of it, then what is happening is that what does it tell you is the option writer writing thing, or if you just go and sell options randomly on a daily basis, will that be profitable? If you just go and add all the greens and reduce all the reds, I think very clearly we can understand that if we just do that, then on a net basis from 2019 till now, or if you go and want to see, you can see long-term data points also, that the net game is not profitable, right? So what happens is that if you are getting some extra IV, or the market is giving you some extra implied volatility, and you feel that I can be an option writer and I can come in the market and sell options and I'm getting extra IV, and generally the volatility is lower than that. Maybe on a short-term basis, you are right, where the IV might be higher than the historic, what the actual volatility is happening. But let's say if the IV is at 20, which you are selling, and the actual volatility in the underlying is 18. So why do you think you are getting that extra 2%? You're getting an extra 2% out of this entire equation. Why do you think you are getting that? You're getting that because you are taking a risk that 2 years, 3 years down the line, sometimes it does happen. So something like when this COVID thing happened, we saw that there were massive losses. Then in 2014, we saw market going down very rapidly. Then back again in 2009, we saw the market going up very rapidly. 2008, everybody remembers there was a big crash. 2006 also there was a steep correction. 2004, right? So every few years, you do see that there is an abnormal movement which the market generally does not expect, but it does happen. And when you are writing options, you are bearing that risk, because if that big movement happens, someday, 2 years, 1 year down the line, we don't know when that is going to happen. But if that big movement happens, then all these small 2% that you accumulated, you will have to pay everything back to the market, right? So what I want to conclude is that if you ask yourself that if I just come and sell options daily, if I just come to the market and randomly sell options on a daily basis, will this strategy be profitable 3 years down the line or 5 years down the line? What do you think will happen? I think, or if you go and look at the actual data points, that there has been severe traps, and in most of the cases, if you go and see, then you might not be able to make a decent return out of it. So that tells us that if you only have theta as an edge, which means that if you are just coming and selling options on a daily basis, assuming that theta will decay and you will keep making money, that actually is a myth, because theta will decay from where? Theta will decay on a daily basis. If the implied volatility is 20 and whatever volatility happened, if that was 18 on an annualized basis, then the difference is actually the decay that will happen, right? So even the volatility and the theta is correlated or intercorrelated, and they both share a relationship that this difference will decay. So theta will certainly decay, but then you might have the other components like vega and gamma, which or delta, which can hit you really bad. So To summarize this, what we have learned so far is that if we look at the historical data, which is this chart, we can see that if you come and sell options on a daily basis, just randomly, if you just sell options, which might be selling ATM straddles, which might be selling 300 points up, 300 points down, or 30 delta up, 30 delta down. But if you're following a very static strategy, then the option equation, or if you look at the Black and Scholes equation, or there are multiple equations, but they all follow normal distribution. And what you are ending up doing is that you are selling some probability, might be a lower probability, but that probability will happen someday. And then you will have to pay back all the differences that you have made. And net, this game cannot be profitable. So that creates a need that if only theta as an edge is not going to sustain in a long run, then how can we go and make money from option writing from a very sustained perspective, or very systematic perspective? So the first thing that we need to fix when we are talking about writing options is that some of the indicators that you can put is that if the market is trending in nature. So when will option writers make money? Option writers will make money when the market is oscillating in nature. But you might not, when you are writing weekly options, you'll not have scenarios that the market is oscillating and it is in a very, very narrow band and you get to sell everything. That will be a very dramatic kind of a situation, or very desirable scenario. But in practical life, that is not going to happen. So what oscillation basically means for me is that if the market is going up marginally or going down marginally, even that is an oscillation. But the only problem is when the market is going up significantly, or if it is breaking down significantly. In those cases, we can say that the market is not oscillating and it is trending with a very, very fast pace. And in only those cases, there is a problem where option writers might lose big time money. So one fix is that if we can identify that what are the phases where the underlying is trending, if that is the case, we shouldn't be writing options. That is one, broader, or you can call it a wrapper over the strategy, that if this happens, then you will just stop writing options. But for all the other scenarios, when the market is not moving abnormally, and when we are talking about moving, it might mean that it is moving marginally up or marginally down. In those cases, what we can basically do is that we can optimize our system by rectifying some of the very, very basic things inside the system. So let me tell you the first thing that we have to rectify, or what the system should rectify. If we talk about, let me give you a scenario that the market, so if we, let's say, let me just open a chart and explain this. So what we can do is we can look at maybe a Nifty daily chart for rolling expiry, so that we can have a slightly long-term data to it, right? So if we look at the Nifty's data, what you can see in this chart is, let's say if I'm writing options around this phase, okay? Or maybe if I'm writing options with the very recent data, which is this data, where the market is going up. So if you see, I think this might be what 1, 2, 3, 4, 5 or 6 weekly expiries might have went through inside this, right? So if you look at this, the market short-term trend is up. And if I'm writing weekly options, so overall, if you see, the low was 15,175 roughly, and the high was 16,722, right? So 16,722 and 15,175, right? So about 1,500 points the market has moved. And if we say that there were 6 expiries inside it, so then we are talking about, on an average, roughly 250 point has been the move in the underlying, and the market has went up. Now, let me ask you that if this is the case, when we are trading, this is the market scenario and we have to write options. In this case, what should be an ideal strategy? Should it be to come and sell 300 point up, 300 point down? Or maybe some people might be over smart and thinking that if I sell 500 point up, 500 point down, I'm safe. But basically, you're not safe. You're just selling a low probability thing. But someday that low probability will also happen, and eventually you'll go and lose money. And that will be to the similar quantum, because you made less money, and when that big move happens, then you will have to pay back whatever the market move is, and then you will end up basically being at zero, right? So just selling randomly options equidistant might not solve the purpose. So the first element of forecasting what we will add is that if you look at the underlying trend, which is this case where the market is trending upward, and if you see for the last 5-6 weeks it has been trending upward, then about 250 point has been the average move that we have seen on a weekly expiry, week to week expiry. There has been a 250 point move. So let me ask you this question, that if given this data point, we know that market is moving up at a 250 points pace upside on a week to week basis. So now if I have to incorporate this in my option writing, what I should be doing? If you think of it logically, then if I'm selling options, or if I'm doing a short strangle, or if I'm doing a short straddle, in both of the cases, so let me take the simplest one, which is short strangle. If I'm doing a short strangle, what I should do is that I should sell calls 250 points away. So if I was selling 300 points away, I need to sell now 550 points away, right? 300 plus 250. I need to sell it far away. And if I'm selling puts, there might be a situation that, I might go and sell just 50 or 100 points down, right? Because there is a trend inside the instrument, and that trend is positive. And you have to incorporate or adjust the selling strikes according to the trend. And that is where forecasting comes into picture. So forecasting doesn't mean that you need to forecast where the market is headed to, but basically whatever is the trend inside the instrument, you need to account for that trend in mathematical terms. For all those people who come maybe from a financial engineering background or physics background would understand that what I'm talking about is a drift, right? So you need to account for the drift, or what is the on an average movement that is happening inside the underlying, and you need to incorporate that, and accordingly you need to adjust your calls and adjust your puts, right? And then this forecasting that you're creating should have a very high strike rate, obviously. That you'll have to make sure that the system you're building is high, because this 250 point has been the historical data, right? But what happens next is something which is not known to you. So your system should be able to forecast of what will be broadly the trend going forward, and incorporate that inside your option writing range forecasting that you are doing. So what I'm talking about is that you need a correct range, and that range should be good enough to justify the option writing. So let me give you some data points. If you just go and sell options randomly on a daily basis, the only theory is that theta is decaying, and I come to the market and I sell option. If I'm doing that, then my strike rate is going to be how much? Roughly about 65 to 66%, because in 2/3 of the cases, the market will not move beyond what the market itself expects. So let me explain this, that if the market is expecting a 200 point movement, then you are getting already a premium of 200 point, right? So adjusting for that, your natural strike rate, all the options which are listed in the global stock exchanges anywhere in the world, you can say 65% of the options basically does not expire in the money. And the reason is that naturally option writing will have a high strike. But is 65% a good strike rate? That is a natural strike rate. And we saw that when we did IV minus FRV, this entire equation did not make money, which basically means that a 65% or 66% strike rate is not good enough when you're an option writer. That might be a fantastic strike rate when we are buying options, but when we are selling options, that is not a good strike rate. So this model that we will create, where there's a need for creating a model basically which can account for the trend, and if we do that, then the idea is that for the range that we are forecasting, we will be able to create a better strike rate. And the forecasting element comes in forecasting the range, not where the market is going up or down, but basically forecasting the correct range, obviously incorporating the trend that is there inside the instrument. So what I'll do is, obviously this is slightly tricky to be done manually. So we do have an algorithm which we are going to talk about today, and that's what the tool is called, Option Writer. So if I just go and click on Option Writer, what happens is that we do see a very big screen opening up. Let me explain you what this thing is doing. So if you, let me just move this. So if you see this, the by default, we have Nifty as an instrument, and obviously you can choose the expiry that you want. For now, the nearest expiry is 28 July, which is also the weekly as well as the monthly expiry. And by default, the days is selected two. The reason it is selected two is that the market is closed right now. So it is going to open on Monday, and Monday, end of the day, if we have to write for intraday for Monday, then what we should do is what this is suggesting by default, because if I drag it below, it will not go below that because the market is closed. So by default, it is going to Monday, end of the day. If I have to sell for one day, on Monday morning, if I come and if I have to sell, then what I should be doing is what it is showing you by default. And then we can see, we'll explain all of these, but we can see the default indicator that we have is Quantsapp forecast, which is basically our proprietary model, which adjusts for the trend and does many more things. But one of the things that it does, which is easy to explain, is that it adjusts for the trend inside the underlying, and you are able to forecast a range out of it. So if you see this, Quantsapp forecast is by default, and we can see on the chart, there is automatically something that is drawn. Let me just expand this so that maybe you can see it properly. So you can see that there is a range which is automatically there on the chart, which is basically the Quantsapp forecast. So the algorithm is telling you that if I have to sell, I'm not saying selling puts right now. That's very tricky, which I'll come to in some time. But basically, if I have to sell, then I should be selling this level on the downside, which is 16,497. Okay. And on the upside, I should be selling this level, which is 16,937. Right. So what the algorithm did behind the scene is that it went inside, understood what the instrument is doing, and then also took the trend that is there inside the instrument and then created a forecast. And this is where, without forecasting, we cannot make money, because if we are not forecasting and if we are just consistently doing what the market is statically doing, then I cannot make money in the long run. So that's why we will have to create a forecast. And in this case, the forecast that we are creating is a range forecast. Okay, what should be the range is the forecast that I'm creating. So what we can see is that the algorithm is telling me on the downside, this should be the level where you should be writing on the downside, and this should be the level where you should be writing on the upside. And if I just calculate how much is the difference in so the Nifty closed at 16,722, right? So the range that is asking me to sell on the upside is how much? 16,937 minus 16,722, right? So if I'm selling for intraday, this is only intraday. I'll come to what we should be doing for expiry as well. But it is asking me to sell 215 points above level. Okay, I'm not saying calls yet, because there is another trick to it, that that might not be the level where we'll be selling the call. So for now, the upside level is 215 points away. And if we see 16,722 minus the low range, which is 16,497, which you can see over there, right? So this is the low range that the algorithm is suggesting me. Then it is 225 points away. Okay, so obviously for an intraday, you will not have a very wide difference, but as we go ahead in time, we'll see that there'll be more difference. But one thing that you should observe is that on the upside, it is telling me to sell 215 points away only. But on the downside, it is telling me 225 points, because it is expecting that the market going down also might have a slightly greater risk. Okay, so if we just, let's say, do it till expiry, and if you look at the revised forecast, then for expiry, it is telling me to sell 17,097. So if we see 17,097 minus 16,722, 375 points up. But on the other side, if we compare it with the lower range, it says 392, right? So maybe right now the market is in a very kind of a equilibrium level, is what you can say, where the difference is still there, but it is very close by. But at times when the market is trending in nature, you'll see that this difference might be anything, because this is completely going and forecasting according to what the market is suggesting will do, right? It is creating a forecast of what the market will do. So sometimes you might see that it might tell you that sell calls 200 points up, but puts 400 points down, right? So depending on the scenario, because the market might be trending down in nature, right? So depending on what the market is doing, it will be able to forecast that you need to adjust your range on the upside and on the downside. And if you do that, what happens is that historically we have seen that if we do something like this, that we incorporate the trend inside the forecasting of the range, then we see that the strike rate of the range of this range forecasting, which if you just go and sell randomly, you have a strike rate of 66%. But if you use something like this and Quantsapp forecast, the algorithm that we have, this is not a new algorithm. We have been using it for over 10 years now. 10 years back, I coded this algorithm for our team, and then gradually it has been improving and improving in nature. But historically, we have seen that doing something like this could give you up to 84% strike rate, right? So that's a significant jump from 66% all the way to 84% could be the strike rate by just adjusting for trend that is there inside the underlying. And there are more things to it. There is volatility and all the other weak components is also going, but I think that's very complicated to explain. But basically, the range forecasting is the first thing that you need, and the range forecasting should have a very high strike rate. But on the other side, it should not be very far away, because if it is very far away, then you're not making any premium and the profitability is not going to be there, right? So the range forecasting should be a high strike rate, yet it should not be very far away, because if you achieve the strike rate of 84% by going far away, then you impact your ROI. The premium that you will get will also be smaller, and you will impact your ROI and you will not make money, right? So the idea is that you should be able to have a very good strike rate of maybe in our case 84%, but you should not go very far away, because if you go very far away, if you go extra far away, you don't get premium. So you'll have to be close by and forecast the range very correctly, because only then you'll be able to make ROI and you'll get a good premium in option selling, and you'll be able to materialize on that, right? So just to summarize what we've learned so far is that traditionally, if we go and just sell options randomly, will give me a strike rate of 66%. Net, it will not be profitable in the long run. But if we do a very basic range forecasting of what should be the upside and the downside range, and if you can create a good model, in our case, Quantsapp Forecast has a range forecasting historical strike rate of about 84%. If we can do that, then immediately we are pushing the probability of making money way higher, right? So writing options with a 84% right range is something very, very good to do, right? Yet we are not achieving it by going far away. We are being very close to what it should be, so that we get more premiums also, right? So that's what this algorithm is doing. Now, before if you notice that I never said that we should be selling these calls and these puts, right? So if I come back to the 1 day, by the way, for people who want to write intraday, might want to choose this as 1. So if you open this on Monday, it will open 0. So 0 means that the market is already, it's the trading day, and you are writing it for today intraday, right? So right now it is showing you 2 days because it's a holiday and we have to adjust for that. So 2 days is basically Monday, end of the day, what will be the level if we sell options, right? So if you see this, this is what it is, where if I sell options on Monday, this is going to be basically the payoff. And if I have to sell it for expiry, I can just drag it all the way to 5, which basically means that I'm selling it till expiry, and I want to sell the options till expiry. Now comes the next thing, that if I have to sell it for expiry, then what should be the strategy? Or the next important thing is that I forecasted the range correctly. Okay, now we have already achieved by using something like Quantsapp Forecast. Historically, the data says that we have achieved 84% strike rate in making sure that the range that I'm forecasting is right. But how will we get that 84% completely will depend on what strategy we go and create, and if the strategy that we are creating is correct or not. Okay. Some people might think, if I have to make money from this range, what I should do? I should just sell 17,100 call option, right? On the upside, and I should just sell 16,000, maybe 350 or 300 put option. That should be the best guess that we should do, because I'm saying that the market will not go above 17,100 and 16,330 from my expiry perspective. So that is what should be the option that you should be selling, but that is not the case. right? So let me explain you. So normally, if I'm writing options, what is the reward to risk that I'll expect? I'll expect a reward to risk of 1:1. That's a very standard way of writing option, that if I got 100 rupees premium in selling option, then I'll not make losses of more than 100 rupees. And that's why the reward to risk will be 1:1. But even a 1:1 is a good reward to risk. Why? Because the strike rate that I have is very high, right? Naturally, it is 66%. But if I'm able to push the strike rate to 84%, then the strike rate is very high. And even if I trade with 1:1, that is absolutely fine. So we'll just go with what the market follows, 1:1, as the reward to risk. Now, keeping that reward to risk of 1:1, I need to maximize my profit, because when I'm selling option, I'm paying almost the same margin to the exchange, irrespective of which option I'm choosing. Almost, if you see, I'm going to give the same margin to the exchange. So with 1:1, my focus would be, or what I want to find is that which will be the strategy. Let's say if I paid 1.5 lakh rupees margin on creating one lot of option writing, then I would want to ask myself, can I go and optimize the return that I can get on it? So maybe if there is a 2:1 strategy, but then it gives me 500 rupees profit, will I choose that, or I'll choose 1:1, which is giving me 10,000 rupees profit? So obviously, keeping that 1:1 reward to risk, I will want to go and maybe look at a strategy that gives me more money. So let me give you one more example. With 1:1, let's say if there is one combination of selling a triangle, which will give me 100 rupees profit, 100 rupees loss. So the reward to risk is still 1:1. And there's the second strategy which can give me 10,000 rupees profit, 10,000 rupees loss. Which one will I choose? I will choose the second one, because when I'm putting 1.5 lakh rupees margin, I'm not interested in making 100 rupees, right? I'm making 10,000 rupees. So that is the case where when we decide on which strategy we should be writing is a very, very tricky thing to do, because we will have to choose the strikes correctly, keeping 1:1 as the bare minimum reward to risk that I need. I need to find that which strike will give me the maximum profit. Okay. And in this case, the algorithm tells me that if this is the range, 17,097 on the upside and 16,330 on the downside, the strategy that we should be executing is 16,750 call sell, which is, it is asking you to come inside the range and almost sell a ATM call option, 16,750 call option instead of 17,100, which people might expect. And on the downside, it is telling me to sell 16,330 was the lower range. So it is telling me to sell a 16,700 put option. Why is this? Because if I do this, so basically what is happening is that the market is expecting a wider range and giving me more premium, but my range expectation is smaller than the market. And that's why the best strategy that I should be executing is almost a straddle. And if I do this, then I will make 10,755 as profit. That's the max profit that I can get. And if my stop loss hits, which is only 16% of the cases, then I will lose 7,100. And if you see, the strategy is already better than 1:1. So you can see that there's a green tick over here, which is saying that this is a good strategy to execute, and the algorithm was able to find a good strategy for you, right? So choosing the strike is a very, very important thing, because I should be able to maximize the profit in the option writing that I'm doing. So let me show you that this might not be static. So let's say if I reduce the days to 4 days, okay, or maybe 3 days. Let me see if we do have a different scenario, or we'll try to create one. Okay, so what we will do is, let me go back again to expiry, and let me manually increase that. Let's say this was the forecast from Quantsapp's algorithm, but I'm saying that on the downside, the market might go more lower, and I'm adjusting this, that this is the downside forecast that I have, just in case if that would have been the forecast by the algorithm. Then you can see immediately the strategy changed, and it changed significantly. Now we can see that what the algorithm is suggesting me, that if this is the forecast, which basically means I just tweaked the lower range from 16,330 to 16,180. But if this is the forecast, then I cannot sell a straddle, because then the risk that I'm taking in a straddle is far higher. And if I want to achieve 1:1 kind of a strategy, then I'll not be able to achieve from the straddle because it can give me more losses, right? So the only best strategy, and the reason I say only best strategy, because these strategies that are being recommended, or the algorithm is calculating the strategy, it is going and calculating all possible combinations, right? So using machines, obviously we can go and do that. So it is solving all possible combinations and telling you that this is the best possible strategy with 1:1. There could not be a better strategy than this. So if you see this, now the strategy has changed and it is suggesting me to sell 17,000 call option and 16,250 put option. Still, it is not selling 16,150. It is coming slightly inside the range. Why? Because we are getting some premiums also. And on the upside also, it is not selling 17,100, but saying 17,000, right? But this combination, if you follow, this is the best possible combination. You can see the color is yellow, which means that it is not exactly 1:1, but it is still doable. And if you look at the payoff, then 2,300 will be the profit if I execute this strategy. That's the max profit. And 2,559 will be the losses if my stop loss hit. So which will be 16% of the cases, and most of the cases, we will 84% of the cases on longer run, we'll see that this will be the profit that I'll make, right? So the first step was that we need to create a forecast of the range, that I should be able to create a forecast with a very high strike rate. I cannot just follow what the market is telling me to follow. And after I create a range, or you can drag this also. Let's say if Quantsapp gave you this forecast, but if you want to change it slightly, you can change it and you can see what would be the revised strategy. The moment I changed the range, we saw that 16,950 calls, 16,500 calls to play out this range. Okay. So what is happening is that first you need to create a range forecast, and then the next important thing is that on your forecast of the range, which could be Quantsapp forecast, which could be your forecast or some other model, on that forecast, what will be the strategy that will give me the maximum possible profit? So every time if I put the right strategy using the help of the machine, if I put the right strategy, then each time I'm trying to push my profitability more. So right now, if I'm executing a strategy with 2,000 rupees profit, and if the algorithm can tell you that if you do this strategy, you can make 5,000 rupees profit on the same call, same forecast, then the extra 3,000 per lot that you're getting is immediately your profit, because that's the benefit that you're getting from mathematics by knowing the mathematics right. And the algorithm is basically solving that mathematics for you, because doing it manually might be really complicated. Sorry. So if you see this, this is what we have achieved. So creating a range forecast, and then what should be the strategy to execute. So if I want to write for intraday, I can just adjust this. If I want to write for 4 days, I can adjust this. And if I want to write it for expiry, I can adjust it. If I want to do it for stocks, I can choose any stock that you want. So let's say if you want to write it for Reliance, you can just type Reliance and you'll get it, right? If I want to write for Banknifty, we can see what is happening in Banknifty as well. So if I want to write for Banknifty, we can just choose maybe Banknifty, and we can see that this is the forecasting. So if you see this, this is the range on Banknifty what the algorithm is recommending. If I want to sell for Monday intraday, the upper range is 37,443 and the lower range is 36,076. But that will basically mean that you go and sell 36,800 calls and 36,700 puts. If I do that, then on a per lot basis, I'll be able to make 4,840 rupees profit on a per lot basis. And the risk that I'm holding, if my stop loss gets triggered, which is this range gets triggered, then I'll lose 2,169, and that will be my stop loss, right? So before I go ahead and explain you how to manage this trade and what will be a good trade management, let me show you some other options that we have inside the tool. So we do have some other options also. So if you look at Bollinger Bands, many people like writing options using Bollinger Bands also. So if you just click on Bollinger Band, what the algorithm did is, is it visible? I think it's not very clearly visible. Let me make it a light theme so that you can see it. I think it is better now. So if I if I use a Bollinger Band, then we can see that automatically this is the range that the Bollinger Band has, which the tool created it for you. And this is basically the Bollinger Band up and down. And if I have to implement that, then this is the strategy that I'll be executing. So if I just increase the days also, I can see what will be the range that I'll be executing. So let me just come back to Nifty again. So what I'll do is, let me just click back to Nifty. So if I see it for Nifty, then this is basically the Bollinger Band for Nifty. If I want to use other tools, I can use something like a Z-score also. So if you know what a Z-score is, you can put the upper multiplier, the lower multiplier, and the moment you save it, it will create a Z-score for you. The internet got disconnected on my system. So if we see what we were talking about is that we can choose different models, and you have something called as a Bollinger Band, which is just everybody knows what the Bollinger Band is. If you want to use that, a Z-score, a straddle range. A straddle range will basically mean that if you add the ATM calls and ATM puts, then what is the range that you have. So if you click that, then you can get a range by adding ATM calls and ATM put. This is basically the range that we have, and that is 16,988 and 16,456. Many people use that, but if you use this again, the strike rate that you will have is 66%. Then you can also use an IV range, which is basically converting the implied volatility back to what the market's expectation is in terms of range. But that will also not give you significant strike rate. That might be just 66, 67% as well. And lastly, many people follow what is the highest call and highest put. So if you just click on this, what is the highest call and highest put, it is telling you that the highest call is at 17,000 on the upside for Nifty and 16,500 on the downside for the given expiry. And if you want to just be with the market by selling the highest call, highest put, then this is the strategy. But still, the strategy is different. If you see, if you have to implement this range, you should not be selling the highest call and the highest put. If you want to use that forecast, fine. But if you have to create the best possible strategy on top of it, that will be selling 16,800 call option and 16,700 put option, so that you can amplify the profitability that you have on that strategy, right? So, and why is this happening? This is happening because we are not getting a premium of 0. We are already getting a 200 rupees roughly premium, 88 plus 115. So if you add that, then basically you will not lose money, even if a 200-point move happens beyond the strike that you have sold. But if you want to make money inside the range, then the best possible profit will be by selling these strikes. So to summarize it, creating a range forecast is extremely important. But after you have created the range forecast, so first the range forecast should also have a very good strike rate. That's how you'll be able to make better profits in option writing. And after you have forecasted the range, you also need to put the right strategy which can give you the maximum profit. And if you are just maybe selling those ranges right now, and as I gave you an example, that if you're getting 2,000 rupees profit, if by choosing the right strategy, you can push that to 5,000 rupees, which I think is easily possible by using an algorithm like this, then that extra 3,000, you'll be able to immediately double your profit technically if you see, right? So by choosing the right strategy and the mathematics, can create a very significant and a big impact in the option writing, right? So one last thing that I would like to show you, or maybe two last things, let me explain you what are all these lights and what are the other data points also. So for Nifty, the algorithm is telling me that gap can also be a risk. So if I'm writing intraday, then I don't need to see this data of gap because the market is already open and post that I'm writing it. But if I'm writing positionally, maybe if I'm writing today and if I want to hold it till expiry or hold it till tomorrow, in that case, I need to also make sure that I'm not holding a lot of gap risk. So if you see this, it is telling me that the risk for a gap up on Nifty is very small. Okay, this is yellow. So this is telling me that the risk of a gap up on Nifty is generally small, but a risk for a gap down on Nifty is significant, right? So this will also mean that when you are creating a strategy, then you need to shift your put slightly far away, and the algorithm is already taking care of it. But just for your understanding, you need to shift your puts slightly far away because there is always a gap down risk which is higher in terms of going down than what the market can do on the upside. Similarly, for different instrument, let's say if I open for Banknifty, then this might have a completely different gap risk. So if I click on, let's say, Banknifty and see it, then Banknifty has equivalent amount of gap up risk as well as gap down risk, right? So every instrument will be completely different. And in this case, that is why the range that it is forecasting is very far away. So if you see, the range is very far away because it also needs to take care that there could be a possibility of a gap up or a gap down, and that could extend to these percentages, right? This could be the maximum, or not maximum, but a median gap risk that you might have if you're writing Banknifty. Now, what are the other data points? So if it is telling me, so obviously the color coding is such that if it is most of the things are red, then there is a problem. But if everything is either yellow or green, then it is good. So it is telling me that if I'm writing Banknifty right now, then the IVR and IVP is not favorable, which means that the IV relatively is very low, and you are not getting a very big IV to go and sell. But we can't really help it. If you have to sell options, you cannot go and change the IV in the market. So whatever is the IV will be there. But you should be aware that this is not the most lucrative trade because the implied volatility is already relatively lower. If you look at Theta, the Theta is in green, which basically means that if you sell options now, yes, the Theta is decaying, and that is good for you. But there's a problem. If you look at gamma, the gamma is red, which means that if I'm selling options right now, then if a big move happens, then I will hold a lot of risk in this trade. And ideally for weekly option, when you go and write on maybe Tuesday, you'll see that the gamma will start becoming yellow and green. So writing options for weekly on Tuesday, Wednesday, Thursday will be more lucrative than writing options way ahead in the expiry when you will not have, so basically what will happen is in those times you might have a gamma risk as well. So what happens is that on the expiry day, you will have a lot of gamma risk and you will see it red. Sorry. On the expiry day, you will have a lot of gamma risk and that will be red. Even now, because it's a weekend, so you're seeing the gamma as red. But in between on Monday, Tuesday, Wednesday, you'll mostly see gamma being green or gamma being yellow. So this is indicating you how much is the gamma risk that you're taking right now. And only because of the weekend, I think it is showing you red. But the moment you enter Monday, I think it should be green or yellow. Theta is green, which means that yes, the options is decaying and the Theta will decay and you have a lot of Theta to make from. And the trend score is green, which basically tells you that the market is not trending in nature. It's a very mild trend. It's not abnormally trending, and that is good for writing options. On the right side, we also have payoffs. You can see what the payoff will be for whatever the strategy is being recommended. Or if you want to see a table view, you can also see that on 25th, if I want to see my payoff at 9:15 a.m., what will be the payoff? At 11:15, what will be the payoff, right? So it is showing you that what will be the payoff on a time basis also. Now, lastly, let me show you one last thing, that after you took the strategy, then the most important thing is that how do we go and manage the strategy. So let's say I'm selling it for 2 days, which is basically Monday end of the day, and I'm doing an intraday option writing. In this case, we can see we are writing for 3,600 rupees profit and 540 is my risk that I'm taking, right? So if I click, we can see that by default, there's alerts, which is ticked, and trade, which is ticked. So if I click on execute, what will happen is that it is opening a alert panel only because I ticked on alert. It is opening an alert panel and it is showing me this is how the trade management should be, that, you know, if I'm writing option, I should not wait for the complete profit to come in. If 80% of the profit comes in, then ideally we should book our profit, and 80% will be 2,897 in this case for intraday writing. So I'm telling the system that whenever I make a profit of 2,900 roughly, inform me, okay, so that I can square off my trade and I can book my profit. Now it is also setting a stop loss alert and it is telling me that whenever my stop loss hits, which is 541 rupees in this case, whenever my stop loss hits, inform me. And then this is the most interesting part which I use, which is that trail the profit. So after 1800, so let me make it, let's say 1800. So after I make minimum 1800 rupees profit, then don't let that profit go away, which basically means that I'm saying the system that after I make 1800 rupees profit, you start trailing my stop losses and trail it to 80% of the profit. So if I say 2000 is the next profit, or on a real time basis, it is calculating the profit that I'm making. So let's say if the profit becomes 2000, then the 80% of it will be basically 1600, that the moment the profit falls below 1600, alert me. If the profit becomes 3000, then it will take 80% of 3000. If the profit becomes 4000, then it will take 80% of 4000. So what happens is that when theta decays during end of the day, it decays very, very fast. And at that point of time, you might just go and book profit at 5,000 rupees, and then you realize that had you waited for another 2 minutes, that 5,000 profit went to 8,000 rupees profit, right? So it is very difficult to know when it is expanding and when it is contracting. So the best thing to do will be that you set an alert that this is the minimum profit I'm looking at. The moment it crosses, then keep calculating on each tick. So behind the scene, the algorithm will calculate on each tick, and you don't need to keep this UI open. You can close the UI, that is fine. The server is calculating on each tick for your strategy, and the moment it crosses the profit threshold, so let's say if I say 2000 rupees, the moment it crosses 2000 rupees, then whenever it falls from there and comes to 80% of the profit, it will send you a notification on mobile. Or I don't have my Telegram account mapped right now, but if you map your Telegram account, you can also choose Telegram. So the moment that happens, immediately you will get an alert that this is the strategy that that you have executed, and now there is an alert, which means that you have something to do. So you can exit the strategy because one of these. If I click on save, sorry for that. If you click on save, then I can see the alert has been set. And whenever that happens, the system will alert me immediately. And now comes the execution screen. So if you don't have an account with one of the brokers that are empaneled with us, you can maybe just take that trade and execute it on the broker's terminal. But if you do have an account with any of the brokers that we have currently, obviously this list is expanding continuously. But for now, we have Alice Blue, Fires, Edelweiss, and 5paisa. If you have an account with them, you can just map your account and choose it. And the moment you say execute, what will happen is that these orders will be sent to the broker, and then eventually it gets executed, right? So let me just summarize it. And before I do that, let me just explain you a very simple concept of hedging as well, because that is something that we have not spoke about. So if you see, the hedge by default is no, okay, because the algorithm, hedge is a matter of preference. It cannot be that the algorithm tells you that maybe 2 lakh rupees is a very good profit and 5 lakh rupees is a very big loss, and you should not make more than 5 lakh rupees loss. That cannot be told by the algorithm, because it's a matter of preference. For somebody, 5 lakh might be a small loss and 25 lakh might be a big loss, right? So if you want to add a hedge, then you can just click on yes. It will just give you the next strikes, okay, but you will need to choose your own hedge. So if I want to maybe hedge this, I can choose that if I take, let's say, 16,900 on the upside and 16,600 on the downside, then you can see this table is changing and it is telling you how my profitability will be impacted. So obviously my profit is also going down, losses is also going down. So you can choose your own hedge, but the algorithm cannot recommend you a hedge because it's a matter of preference, that I prefer not losing more than this much money. But if you want to do that, the only thing is that the moment you select it, when you say execute, then it will create an order form along with the hedge, right? And you can just execute all the legs at once. And I would recommend, if you're trading Nifty, Banknifty, just go with a market order so that you don't end up in a risk of 1-2 leg getting executed and the remaining being pending. So you can just do it as a market order. For stops, obviously use a limit order and then execute those trades. In real market, when the market is when the market is on, you'll see that all these prices will automatically change in real time, so that your prices are very real, and when you're selling it, it goes on bid, and if you're buying it, it goes on ask, so that everything is taken care of, right? So I think I've covered most of it. One last screen that I want to cover is the selector. So if I want to find that in a single screen, if I want to see that according to Quantsapp forecast, what is the Nifty's upper range, so I can see that the lower range and upper range is right there. If I want to see Banknifty, I can see for all the stocks, I can see what is the upper and the low range. For the dashes, it has not been able to calculate for this because maybe the instrument is very new or the options are illiquid. That's why it is not able to calculate. If I want to see for expiry, I can just click on expiry, and for all the instrument, if I want to see where which upside and downside I should be writing, so you can see Nifty. If I'm writing for expiry, the upper range is 17,156. And if you want to do some sorting also, you can do that to see which are the options which are very far away. So if I'm selling ABB, I will have to sell 13% up call options and 15.6% down put options. Why? Because ABB has been very volatile off late, right? So for stocks also, you can get signals accordingly, right? So let me just summarize. If I go back to the home screen, as an option writer, if you're just selling options randomly, you have a 66% strike rate. But if you use the algorithm that we have, and which basically rectifies these problems for you of creating the right range forecast and then choosing the right strategy, then you can amplify your strike rate in option writing. And all you have to do is just click on option writer. So let's say if I just go and click on option writer, then everything is automated. It automatically tells you that this is the range that you should be selling. So this is the range 16,937, 16,497 is what you should be selling. And this is precisely the strategy 16,750, 16,700 that you should be selling. Just directly hit on execute. It will open all the pre-filled alert for you. If you want, you can certainly change it. But if I save it, then all the alerts are set. I can just go and execute. What will happen is, so I clicked the option writer, it gave me the strategy. All I have to see that the strategy should be either in yellow or green. Okay, and I click execute, the order goes through. Whenever we have to exit, the system will automatically send you an alert on mobile or Telegram. And whenever you get that alert, you have to exit your trade, right? So if you see this, if the strategy is green or yellow, you can execute. Only in the cases when the strategy is red, then it's not the red basically means that you're not getting enough reward to risk to select, then maybe you would want to avoid it. So I think that's all from my side. I can take a few questions if you have. So I think you can post it on whichever platform you're watching it on, YouTube or other platforms. You can just post your questions on the chat and the team can forward it to me and I can answer it. Okay, so one query, what happens to pop if hedged? So, okay, so the pop will change. So somebody has asked a question, what will happen to the pop if I hedge? So let me go back to the tool again. What I can do is the same strategy. I can go maybe to architect. So if I open architect, and if I want to see how does the pop change, right? So let me just move this panel. Okay, so if I open architect and if I go with a short strangle, so which will be an oscillating strategy. So if I just go with a short strangle, okay, let's say this is the strategy that I want to execute, 16,800 calls and 600 puts. If I just save it, let me just move this back. So we can see that the expiry pop for this strategy is, so the pop for 1 day is 84.63 and the expiry pop is 77.81. If I create a hedge on top of it, obviously the pop will change and you can see what is the new pop right there. So if you have this kind of a scenario that you want to see how the probability is changing, you can just add the strategy and tweak it and check in architect of how the pop is changing. Okay, so the second question that we have is, what is replicate on top right? Okay, so somebody has asked for the option writer, in the option writing tool, if you know that the strategy is automatically being recommended. So what happens is that let's say if I change the strategy to 16,650, and then I don't know what was the original strategy that was recommended. So it's there, right there. So if you want to just copy this strategy, the moment you click on replicate, it automatically takes that strike again into account. That's what basically replicate means. Let me see what are the other questions. What to do when quarterly results are there? So normally when results are there, then I would not recommend you to go and do option writing, because especially for stocks, because what happens is that you are taking a lot of unsystematic risk that the instrument might move heavily up or heavily down. So if it is the result season, then I will not recommend you to write stock options. But you can still do it with an hedge if you want. But I would recommend you not to do that and just stay away. If you know that there's a result upcoming for any stock, then don't write options. So somebody has asked a very good question, that can we write options directionally using the tool? Certainly, yes. So if you want to write directionally, which means that you are already maybe holding or not holding some stock, and if you're not holding, you want to write only puts, then you can just take the lower range is there and it's just telling you what the lower range is, and you can just go and sell that put option. That's it. So you can do that also. And let's say on the other side, if you're holding the stock and if you want to sell a call option, then you're getting the upper range, you can go and sell a call option for that as well. So the other question is, what is the difference between your range and analytical range? So your range is basically, if you change the range in the graph, then it shows you what is your range. But the analytical range is what Quantsapp's forecast range is, that is telling you that this is the analytical range. So I think we have already taken a few questions, and if you have more questions to that, then you can certainly write it to our support team, and the support team will be able to guide you on any of the questions that you might have even post this webinar. So let me just summarize what we have learned today. If you just come and sell options randomly on a daily basis, then you have just a strike rate of 66%, which we saw using IV minus FRV, that is not good enough in the longer run. So you need to have a good range forecasting, and the range forecasting should have a good strike rate, as well as it should not be very far away, so that you make a good ROI on it. So you have to first forecast the range with the Quantsapp forecast is creating a range with historically 84% strike rate. And then the next step is that you need to choose the right strategy on that range. So if you choose the right strategy on top of that range, then you'll be able to amplify even the profits from that range also, that what should be the profit on that range. And for all those people from our team, if you want to go ahead with a Pro Plus subscription, then we have a 10% off today, and you can use this code, which is +10, and you'll be able to get a 10% off, and you can use the platform across web and across mobile, which you already know. So that's all from my side. I think we have already answered all the questions, and I wish you all the best in your option writing trades. Thank you very much.